Hi, everyone. I'm Michael Henley, the CEO and founder of Brandywine Oak Private Wealth. I am joined by Peter Kim, our Chief Investment Officer. Today, we're going to look back at the third quarter and kind of see what took place and summarize for us on where the markets and economy are headed. So, Peter, let's go ahead and jump in.
Absolutely.
It's been an interesting year so far, to say the least. For 3 quarters in, despite some of the uncertainty in the economy, things keep moving forward. How have the markets been year to date?
Who would have thought all-time highs, right?
Yep.
Across the board, pretty much on every index. Who would have thought this in the middle of April when we were down 20% for the year?
Yeah.
All of a sudden they come rallying back very quickly. And now when you have this landscape of the Fed cutting rates, you have interest rates probably coming down, mortgage rates eventually coming down with that as well.
Mm-hmm.
That's a nice backdrop for credit markets and to continue to push the economy forward.
So all this concern in April around the tariffs, did that kind of just, the market just kind of just work that out, or what actually happened there?
The biggest concern, it seems like, was the fact that it was going to cause some sort of inflation shock to the system, and that was going to cause us to fall into a recession. So far, we just have not seen that inflation really show up from the tariffs in the way that everyone was kind of expecting it to.
Okay.
So because of that, the market's been able to absorb a lot of those shocks, and these corporations have been able to absorb a lot of those cost increase and haven't been able to push or have not pushed them onto the consumer as much as people expected.
Got it.
We shall see if that continues in that pace, but so far, so good.
Yep. Okay, great. What's the latest for U.S. markets in general? Are we still seeing momentum, or are things shifting?
So far, so good. You're seeing tech companies continue to spend money. You're seeing consumers continuing to spend money. So that's a big deal because they're obviously the largest part of the GDP.
Mm-hmm.
But as long as people are still spending money and corporations are still spending money, at least on technology-related investments, it's going to help push the markets along, right? You're not really seeing corporations hire anyone at this point, but they're also really gun shy to fire people.
Okay.
So that's then keeping everyone relatively employed. That's also then keeping people spending at this point. So barring some unforeseen shock to the system, that should be able to continue to prop us along or kick the can down the road for a little bit longer.
Are we still driven entirely by like 7 stocks, or is the overall market doing better in the US?
It's a good question to ask. We are finally seeing some breadth of market, which is great. So everything is starting to expand out. And if you think it's maybe just because AI is expanding, that's okay too, because that then is now matriculating out to energy stocks, right? It's matriculated to infrastructure stocks. It's matriculating out to other parts of the market beyond just the straight semiconductor and infrastructure space.
Got it. Okay. So more than just NVIDIA is doing well.
Absolutely.
All right, good. How about foreign markets? It seems like no one expected like a 30% return from foreign stocks this year.
Why not, right?
That's,
at some point they're going to work, and it's good to see they are finally turning around. They've been carrying the load for the first half of the year, first 3 quarters of the year, which is nice, as the U.S. is kind of shaking everything out.
Yep.
I wouldn't be shocked if U.S. plays a little bit of catch up as Europe starts to slow down a little bit. I think they have some structural issues they have to address to kind of continue to grow as they commit to spending more money as governments, but at the same time, their debt to GDP ratios are a little bit higher than ours to start with. So you have some issues there you have to kind of address.
Okay.
But so far, so good. And again, you kind of like the tailwinds that they have right now.
Weak dollar, right?
Very weak dollars. That's good for them. They're continuing to spend money, so that's good for defense. They see the writing on the wall that the administration wants to kind of pull back and have everyone else carry a little bit more load. So that forces them to kind of spend a little more and juice up their economies in some form or fashion.
Okay. Talk us through, with foreign stocks being up significantly, gold. I mean, gold's up 50% this year, what have you. No one, it seems like it's headlines everywhere. What's going on there?
Yeah, it used to be an inflation hedge. Now it's probably more of an uncertainty hedge.
Okay.
Just don't necessarily know what's going to happen. And I think people like that tangible asset again. You're also seeing global governments, they're starting to build up the reserves. They did not necessarily want to continue buying the dollar as much as they were as a main backer. So they're slowly increasing their gold reserves as well. So that's also kind of putting some upward pressure on the price.
Okay, fascinating. There seems to be a lot of talk about the Federal Reserve lately and interest rates. So what happened in September and kind of what's the outlook going forward?
Sure. So the Fed started cutting rates again in September. It's good to see. I think that's a welcome reprieve and it's a good start. It's certainly not the end point of where they need to be at, but it's at least starting the process of cutting rates again and getting us on that cycle.
Okay.
Whether or not they cut moving forward in October and going into December at the end of the year, we shall see. I think they're still very data dependent and are now kind of flying blind with the government shutdown because a lot of this data is just not going to be available to them. And you have to question how accurate is it now going forward, just given that the government is shut down. They're not collecting any data right now.
Yep. Okay. Got it. So when the Fed's cutting rates, that's short-term rates, right? So money market rates will be impacted, but long-term rates, do they typically follow suit, or?
They will eventually follow suit.
Okay.
Especially over very, very long periods of time. But you're right. The most immediate impact is your savings account, your checking account.
Yep.
What minimal interest you were getting there, you're going to be getting a little bit less then.
Okay. And mortgage rates have come down a little bit?
Mortgage rates are a little bit trickier. They've come down a little bit, but they're not a perfect correlation to the Fed funds rate.
Okay.
Cuts interest rates. They're more tied to the 10-year treasury yield, and 10-year treasuries just haven't felt the same kind of relief that the short end of the curve has.
Okay, makes sense. How have our portfolio models been positioned in this market environment, and what adjustments did we make recently?
Sure. So thankfully, we've been very patient with our models. We did very active, prudent tax loss harvesting in April to take advantage of that downturn, but we were not actively trying to de-risk anything given that kind of market makeup. So thankfully, we're still fully invested in a lot of our portfolios. Our clients will ride out that upswing. And honestly, we've been very nice in capturing all the market return on the stock side.
Awesome.
On the bond side, we've been a little bit more conservative than everything else. And I think that's okay, because we want to be a little more conservative for most of our client base on the fixed income side of the portfolio.
Yep.
We've slowly started to increase our duration there. We didn't want to take on a ton of credit risk. We're still a little leery of what can happen in the markets. So we have some sort of kind of rotation or wobble, but increasing duration, knowing that interest rates probably are going down before they come back up, that makes sense to just capture a little bit of upswing there.
So increasing duration, just for, just to explain that. So basically longer duration bonds, I take it. So basically, so longer duration bonds that'll, that theoretically we're locking in the yields. So when rates come down on the short end,
yep,
we're okay, got
absolutely. So think of it as locking into a longer term, higher yield investment for a longer period of time, knowing that you're going to get more in relation to something else, because there's going to be issued at a lower interest rate.
Okay, that makes a lot of sense. All right, as you know, we like to reinforce the 8 laws of investing. We are back to law number 1, which basically says that the best investment strategy is the one you can stick with, full stop, basically. Now, can you explain, Peter, what does this mean, in English?
Sure. Investing is all about giving the markets time to work and sticking with the strategy and letting it go for a full market cycle. Everyone loves volatility on the upside, because that's when you get market returns.
Yep.
No one loves volatility on the downside, but that's part of a normal part of a market cycle. And you have to be willing to see the downturns, because typically after a downturn is when you get the quickest snapbacks.
Okay.
April is a perfect example of that.
Down 20% and back to all-time highs.
Back to all-time highs within a month or two.
Okay.
Right? You want to be able to, yes, no one wants to see the downturn, but if you know that it's a regular occurrence in the market,
yep,
and it's a regular cadence of a bull market cycle, it's a little bit less of a shock to the system, knowing that I don't necessarily care about what happens to the market today or tomorrow, because I'm worried about 15, 20 years from now.
Okay, got it. So staying fully invested is the big takeaway there.
Absolutely.
Got it. Okay, outstanding. All right, Peter, well, thank you so much. And thank you, everyone, for joining us today. If you have any questions, feel free to reach out to us at Brandywine Oak, and take care.